Hey Bowtie Nation, Joseph Hogue here with a video that will pay for all those unexpected expenses. You know what I'm talking about. It seems every month it's an unexpected expense eating away at the budget and keeping you poor. So I'm sharing 12 monthly dividend stocks, one for each month, extra monthly income to boost your budget. We're already in February, so let's just start there, just in time for Valentine's Day on the 14th. Why not get her a dozen roses and a plush groundhog to say, I wish every day could be like today. And to pay for your Valentine's spending, you'll need to invest just $550 in the Global X S&P 500 Covered Call ETF, ticker XYLD, with its 13% dividend yield. How this is going to work, that 13% annual dividend and the $551 invested is going to send you just under $6 a month, so that when February comes around each year, you'll be ready with that cash to buy her whatever her heart desires. The XYLD is the first of two covered call income ETFs that I'm going to highlight, this one holding stocks in the S&P 500 index, that largest 500 companies based in the United States like Apple, Microsoft, and Warren Buffett's Berkshire Hathaway. Now that's going to give it some safety versus some of the riskier stocks like the tech-focused NASDAQ. Then the portfolio managers are going to sell call options each month against these stocks, collecting a premium to generate cash for that dividend. And that strategy worked great in last year's stock market crash. The XYLD did lose 20% in the sell-off, but considering that's only 4% worse than the broader stock market, the S&P 500 shown here in red, while the fund paid out an additional 11.5% in dividends beyond that market index. Overall, it's a great way to invest across the stock market, but also get a much higher cash return. Now, the XYLD at a 13% dividend isn't bad, but it's not the highest yield on the list, so stick around for that. March brings St. Patrick's Day on the 17th, and before that, International Fanny Pack Day on the 9th. I recommend buying enough green beer that you skip Fanny Pack Day altogether and sober up just in time for St. Patty's festivities. To help you do it, join a Spirits of the Month club. For an average of $55, you can get a bottle of booze each month and be blissfully ignorant whatever day it is all year long. $55 a year on a 10.1% dividend yield means investing $545 in shares of PennantPark Floating Rate Capital, ticker PFLT. Pennant is a BDC but specializes in floating rate loans, something that could help it increase that yield as interest rates rise. 87% of the portfolio is in secured debt on first liens, with another 13% in equity investments to give it more of that upside growth. Now, that high percentage of loans with first lien status is going to help it protect it from any downturn in the economy, while that higher equity position will help it rebound later. The company's current portfolio of loans to 125 companies is diversified across more than 30 industries, with an average loan size around $10 million. And a 10% average portfolio yield. We'll get right back into our list, but first I want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign up link below. Back to our list of monthly dividend stocks, and after April Fool's Day, you might not believe that April 6th is International Pillow Fight Day. But you better be ready. International Pillow Fight Day means it's a world war, and that means coming prepared with this 20 by 54 inch full-size wrecking machine. For that $67, you'll need to invest $930 in the InfraCap MLP ETF, ticker AMZA, and its 7.2% dividend yield. It'll be worth it though when you're the last one standing in a pile of bloodied feathers. The MLP fund holds master limited partnerships, companies that own oil and gas pipelines as well as storage and processing facilities. Now, these are very high-yielding assets because they charge oil companies a fee to transport through the pipelines and then distribute at least 90% of their income onto investors. The best part about investing in an ETF like this is you don't have to manage that special K-1 tax form you get with individual MLPs. And the boom in oil prices last year has taken this one up 16%, beating stocks by 30% while all producing that 7% dividend yield. Oil prices are likely to stay higher this year and next, which means this is definitely a place you want to be. Mother's Day on May 14th follows World Tuna Day on the 2nd, so make this one a twofer and get Ma a 24-pack of Chunk Light Tuna for $45.36. Because nothing says I love you like tuna. Best of all though, you'll be able to buy it on just $428 invested in the JPMorgan Equity Premium ETF, ticker JEPI, and its 10.6% dividend yield. This is easily my favorite among the covered call ETFs, though I do like that XYLD we talked about earlier. The portfolio managers here have over 60 years experience in equity and derivatives, and it shows in this fund's performance. The fund invests in defensive, large-cap stocks like insurers, consumer staples, and pharmaceuticals. You see here, it's all those bellwether stocks like AbbVie, Coca-Cola, and United Health. That gives it true safety when the market tumbles. And then the portfolio managers sell those call options on the S&P 500, that broad stock market index, to generate the cash flow for dividends. And that strategy has worked extremely well. You see here in a chart of the price returns on the JEPI versus these other popular covered call funds, including the QYLD, the NUSI, and the XYLD. The JEPI lost just 0.88% over the last 2 years versus losses of 30 and 33% in the NUSI and the QYLD, even a loss of 15% in the XYLD. We've still got 8 more months left to pay for it, but I want to explain how these monthly dividend stocks work because I know there's a lot of questions out there about this. Now, while each of these stocks and the funds pay a monthly dividend, remember, when you see a percentage dividend yield for a stock, that is always a yearly basis or a yearly percentage. For example, we saw that the JEPI here pays a dividend yield of 10.6%. And that means the 12 monthly dividend payments together, or about $5.85 in this case, that is about 10.6% of the current stock price. And that's $5.86 divided by the stock price of $55.19 a share. But again, remember, that is an annual dividend. It's paid out over 12 months, so a monthly basis. Most dividend stocks try to pay equal amounts each month, so investors can plan it around their needs. But some of these, like the JEPI fund, well, you get what the fund is able to pay out. And what does all this mean? Well, if you want your dividend stocks to pay your bills, then you're going to need to do a little planning. You can find how much you need to invest by dividing the amount you need by the dividend yield. For example, to pay for our $45 in I Love You Tuna with a 10.6% dividend yield fund, we divide that $45 by 0.106 or 10.6%. For $425. Now in our example, since we only needed that $45 once a year, then that's where it ended. If you need a certain amount each month though, then you're going to need to multiply that by 12. The JEPI and its 10.6% yield is going to pay us that amount in 12 monthly installments. So if we need that $45 a month, I don't know, maybe you're a child of the sister wives and you got 12 mothers, then 45 times 12 is $540. And then that much divided by that 10.6% yield, that's going to mean investing $5,094 is going to give you that $45 every month in dividend income. A little confused? Probably. But let's move on. Next in our monthly stocks to pay the bills, June is the most popular month for vacations, with nearly 1 in 3 U.S. adults planning a trip. Plan ahead here and you can be in Chico, California at the Yo-Yo Museum for National Yo-Yo Day on June 6th. The museum is free to tour, but budget yourself $1,000 for the trip and invest $9,090 in shares of Horizon Technology Finance Corporation, ticker HRZN, and its 11% dividend to pay for it. Horizon makes secured loans to venture and private equity-backed companies in the life science and technology industries. Now that's a market that's taken a hit over the last year's crash, but it's a strong growth area to be in for these business development corporations like Horizon. The portfolio of loans is well diversified by sector, geography, and company stage. Now, all these are going to be those fast-growing startups backed by venture capital and again, a great niche in healthcare and technology. So besides that high dividend yield you usually get from the typical business development corporation, here you're going to get a little bit of a growth stock as well. The average yield on the portfolio debt is 16.3%. Well above the 7% dividend yield. And in fact, I think the biggest yield spread I've seen in BDC stocks. That keeps the dividend safe, and it's going to mean the stock price should continue to rise. Horizon also has all the funding it needs in the near term, with a $45 million share offer last year and a $100 million debt facility. Celebrate the 4th of July and our nation's independence by blowing up a small part of it. In fact, kill 2 birds with this one and combine it with Take Your Houseplants for a Walk Day on the 27th. A family pack of M98 firecrackers and a median houseplant is going to set you back $35, meaning you could be blowing shit up for about $466 invested in Gladstone Investment Corporation, ticker GAIN, and its 7.5% dividend yield. And why I like gain here is because it's going to take a higher equity share than most other BDCs. Remember, those business development corporations, they're mostly making loans, so the upside is going to be capped on that interest rate. But Gladstone targets investments of 25% equity and 75% debt versus a traditional BDC that's going to look for less than 10% equity in the companies it works with. Now, that higher equity ownership might mean higher risk, but it's also going to mean higher returns on these investments. And we see that here in Gain's history of returns on equity, which is well above the industry average. The 5-year average ROE of 17% is over 3 times the median ROE in the BDC group. And even though this near-term return has come down, it's still well above the average for the group. Gladstone's current portfolio is spread across 28 companies in 14 industries, so that level of diversification there should help continue those returns even in a sluggish economy. Their shares have done so well, in fact, that it's been able to pay out multiple special dividends, boosting that cash return. More babies are born in August than any other month. Let me see, what were we doing last December? If she can hold it in for at least a week, though, you can be celebrating International Clown Week, August 1st through the 7th, before buying all those diapers. A 200 pack of disposable diapers and a red rubber nose is going to set you back $58.69, or $674 if you invest in the Gladstone Capital Corporation, ticker GLAD, and its 8.7% dividend. Now, you're going to notice that most of these individual stocks in our high dividend list are either real estate investment trusts, or REITs, or business development corporations, BDCs. That's because these are special types of companies. They get a tax break if they pass on at least 90% of their profits to investors as dividends. It means a very high dividend yield, but can also expose your portfolio to risk if you have just a lot of your money in just these two types of companies. Now, for that reason, I usually say have less than 30 or 40% of your money in these REITs and BDCs. You don't have to invest in every stock on our list. Just pick out a few you really like here. I think the two groups can do well over the next few years on those higher rates, but you do need to know how to analyze these. But then if you are kind of overexposing a portfolio to just one type of company, especially these BDCs, you want to pay special attention to each company's sources of capital and its business. For example, in here, this every BDC is going to show you the industries in which it loans and the types of loans it's making. You see here that Gladstone is well diversified across 17 industries, so a major event in any one group probably isn't going to materially affect the company. One great way to get that newborn started is with free stocks by opening an account on Webull. Start an account on Webull now and get 2 free shares just for opening the account. Deposit as little as $100 to start investing, and Webull is going to give you an additional 10 more free stocks. That's up to 12 free stocks worth $3,000 to $3,000 each, just for using the link I'll leave below. I use Webull for the Stock Simulator feature, a paper portfolio that lets you follow your strategies and stock picks before investing real money. You'll also see analyst research, stock price targets, and get to invest in multiple markets around the world. Even if you don't use the app though, use the link I'll leave in the description, sign up, and make a deposit. You'll get those free stocks worth up to $12,000, and you'll be helping to support the community, so I appreciate that. September is Kids Take Over the Kitchen Day on the 13th. Hopefully not the newborns born in August, but you're still going to need money to buy a new skillet after Junior tried making grilled cheese sandwiches. You're getting off cheap on this one though for just $25, or $385 invested in shares of LTC Properties, ticker LTC, and its 6.5% dividend yield. The Real Estate Investment Trust owns 180 properties in 27 states, with skilled nursing accounting for about 56% of revenue, and assisted living centers bringing in the rest. And I like this one because even if vacancies tick up a little bit or the economic recovery stumbles, LTC has over $503 million in an available credit line and $50 million in balance sheet cash. The company has long-term debt of just $689 million, but only $185 of that is maturing through the next 2 years, so it's got all the liquidity it needs to make it through a recession. Long-term, though, this is a great play on America's aging population, the demand for senior living facilities, and the stock is selling at a discount. Now, that dividend yield of nearly 7% is safe, and I think you book another 5 to 10% a year in appreciation over the next decade. October ends with Halloween, but begins with National Noodle Day on the 6th, so why not do both and trick or treat as a noodle? It's going to cost you just $255 invested in shares of Prospect Capital, ticker PSEC, at its 10.2% dividend yield. Prospect is another business development corporation, a BDC founded in 2004 with over 16 years of dividends and performance. The company manages a $5.7 billion portfolio of 122 investments in companies across 37 industries and earns that 10% yield on its portfolio. Now, that loan portfolio yield is just slightly below the dividend yield, but the company has plenty of liquidity to cover the cash return as the portfolio yield increases. In fact, Prospect has returned a cumulative $20 per share in dividends for more than $3.8 billion since its 2004 IPO, and the payouts just keep climbing. That's the purpose of these BDCs, is to act as a bank and investor to those mid-sized companies, manage those assets, and then return that 90% of earnings as cash flow to you as an investor. November 11th is Veterans Day, and just so happens to be a day after the Marine Corps' birthday, so wish your favorite bow tie veteran a happy birthday. And seriously, how about a $50 donation to the Wounded Warrior Project? The Wounded Warrior Project helps service members returning home with programs like mental health, career counseling, rehabilitation, and family support. Folks, I've seen personally what the WWP has been able to do for my military brothers and sisters, support that has saved lives. Just go to woundedwarriorproject.org and you can make a one-time donation or a monthly gift. Any amount here is appreciated. On a 7.8% dividend yield, investing just $640 in shares of Gladstone Commercial Corporation, ticker GOOD, is going to spin out that $50 a year for your donation, and I thank you for your help. The company owns more than 15 million square feet at 122 properties in 28 states across the United States. Leases are spread across 106 tenants in 19 industries, so this is another REIT with multiple property types. About half the rent comes from office space, with another 41% on industrial properties, and the rest in medical office and retail. Occupancy has held at 96.6%, and with the average lease term of about 7.5 years, that means even a more severe recession, they should be able to support the rent. While Gladstone doesn't have a history of dividend increases, it does have a long track record of payments and a good yield at a healthy price appreciation. Just 2 more months left on our monthly dividend list, and besides Christmas spending, December is also National Underdog Day on the 16th. Not that underdog. I'm talking about the perennial losers, the Arizona Cardinals, the most losingest team in the NFL, with 790 losses. So start the holidays right with an 8-pack of Super Glue for quarterback Kyler Murray. For just $9, you can bring some holiday joy to Phoenix, or just $123 invested in shares of Main Street Capital, ticker MAIN, and its 7.3% dividend yield. Main Street is another business development corporation here, specializing in those loans and the equity investments into mid-sized companies. With shares producing a 9.2% annual return over the last 5 years, this company has regularly increased the dividend, now up 105% since the 2008 IPO, and often pays a special dividend. Main Street has 182 portfolio investments as of the most recent quarter, with the largest representing just 3% of the total fair value, so a hit to any of these investments isn't going to hurt the shares much. The weighted average portfolio yield on the portfolio is 9.6%, so well above that dividend yield, giving this one sustainability and room to grow. We've got one more dividend stock, the highest paying in the group, but one of the complaints I hear so often about monthly dividend payers is inconsistent dividends, never knowing how much a stock is going to pay. Check out the video here for a weekly dividend stock portfolio, though, with consistent cash flow every single week. For January, though, in our highest dividend paying stock, forget the New Year's resolution to join a gym and celebrate Beer Can Appreciation Day on the 24th. A 12-pack of full-size bottles each month is going to set you back $539 a year, but it's going to be well worth it when you black out every other day on the list and save all that money. Making that $45 a month means investing just under $4,000 in shares of AGNC Investment, ticker AGNC, and its 13.5% dividend yield. Now, this is a mortgage REIT, an MREIT. It's a special type of real estate company. These REITs borrow money on short-term rates, then leverage that up by borrowing 2 or 3 times as much to invest in long-term mortgages. This is the interest rate on repurchase agreements, a special overnight short-term rate many mortgage REITs use. And you can see it's been at almost nothing for much of the last decade. So these MREITs, they're going to use that borrowed money and the invested capital to invest in mortgages with higher rates. So if you take that 4 or 5% interest received on a 30-year mortgage minus the near zero rates they're paying on those borrowed money, it's been a very profitable business and great dividend cash flow. AGNC holds a $61.3 billion portfolio of these mortgages. 91% of that is in 30-year fixed terms, and most of these in safe, agency-backed mortgages. 2 things you want to watch for when investing in these mortgage REITs like AGNC is the book value per share and the net interest spread. Book value on the left here is the value of the mortgages the company holds, and you can see this has dropped pretty consistently since last year as interest rates increase. The problem there is higher interest rates means those old mortgages and the bonds are worth less because they pay that lower rate than the new mortgages coming out. For example, the rate on a 30-year mortgage has doubled from under 3% last year to almost 7% recently. So anyone holding those old mortgages as an investment, the MREITs, the portfolio isn't worth as much compared to those new bonds. The good news here, though, is that the stock is trading for a significant discount to that book value. Here you can buy a share for $11 each, a 12% discount to the actual value of the mortgages held in the portfolio. Now, that discount to book value is always a great place to start when you're buying these MREITs. Another bit of good news here, though, is the net interest spread here on the right. That's the difference between the interest the company pays on its borrowed money and what it collects on those new mortgages. You can see the profitability is getting higher. So once those interest rate levels start to level off or stop increasing so quickly, this could again be a great cash flow stock. Click on the video to the right for that special 12 stock portfolio that will send you a dividend every single week. 12 dividend stocks for weekly cash flow. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.